Hello, I am Ilan Handelsman from Raintree Financial Solutions, and I'd like to thank all of you for joining today. We've got an exciting presentation. I am joined by the Durum team, Jay Simmons, Amy Kramer, and Chaim Karpel, and I'm going to hand the presentation over to them. We are going to do a Q&A at the end. What I'd love for you to do is to please, at the bottom center of your screen, click on the Q&A box, and please type in any comments or questions, thoughts, ideas that you have, and I'll be facilitating those questions at the end of their presentation. So with that, I understand that Jay and Amy are going to be doing the presentation, so over to you for now.
Perfect. Thank you so much, Ilan, and thank you so much to the Raintree team for having us on the presentation today. We are very thrilled to be discussing Durum Industrial REIT. We'll give you a bit of an overview of what we do and how we do it, and how the performance of the REIT has been over the last number of years. So just before I hop in, as always, a bit of a general disclaimer. There are risks to the investment, and we encourage you to speak with your private wealth advisor to learn of those risks. There is no guaranteed return, and please do refer to the redemption policy for any of those outstanding items. But just before we jump into the bulk of the presentation, I wanted to spend about a minute just talking about why industrial and why the industrial asset class is an area that we look to invest in alongside our investment partners. So with that, I'm just going to play. Think about your buying habits. How often are you ordering online? How have your consumer preferences changed? And when you peel that back to think about supply chain, think about the real estate required to fuel your transactions. It's the distribution centers, logistics, warehousing, and manufacturing. That's industrial. JLL Research notes that the asset class remains resilient during the ongoing pandemic, with low vacancy putting upward pressure on rental rates. Durum Industrial REIT offers an opportunity to invest in a private real estate investment trust strategically positioned within the industrial sector. So we share that video to kick off the presentation just to touch on why we like the industrial asset class and where we see it going. But I want to take some time and pass it off to Jay to talk a little bit on his thesis and why the industrial asset class and what he's found as an investor within this space.
We got into industrial real estate back in 2011. And at that time, I was looking for something that would give me sort of stable cash flow. I'd done a lot of investing in various other industries and spaces and wanted something that gave stability through time and just something that I could rely on cash flow coming in on. And so real estate is an obvious spot to get into. And so we thought a little bit about residential, office, shopping centers, and the industrial class. And all of those had elements of sort of pros and cons to them. On the residential side, they're actually quite complicated assets to maintain. You've got tenants coming and going all the time. You've got kitchens and bathrooms and a lot of moving parts in those buildings. And they also trade at incredibly low cap rates. So it's tough to get paid a lot of money owning residential assets. So that one didn't excite me too much. The office space is interesting, but generally you get a lot of competition from very low cost of capital pension funds, and owning iconic downtown buildings and on down the line it's quite capital intensive to get into it in size and sort of the higher quality asset class. So that wasn't entirely perfect for us. Shopping centers, and I guess hindsight would prove particularly good on that, because we've had such a shift away from the marketplace happening in shopping centers to online activity and on down the line. But the other issue with shopping centers is every agreement that you sign with a tenant, they tend to have restrictions on what you can do. So like when a Starbucks lands in a location, they prevent you from anybody else selling coffee within a certain radius of that. Others who are retailing various other things. So you have to get this almost feng shui about the tenants that come into the location. And when I looked at the returns that I was getting on it, there wasn't appropriate pay for it. And then we looked at this industrial asset class, the least sexy asset that you can buy. They're, big boxy buildings with not a lot of exciting architecture wrapped around the whole thing. But they have industrial tenants. They come in, and with industrial tenants, they're generally larger corporations. They have robust balance sheets, or at least that's what we're looking for in the ones that we bring in. The problem with it is generally you've got one tenant per building, and it's harder to get a diversified portfolio until you get a group of projects put together. Anyway, we started off with 3 or 4 buildings. It was myself and a couple of other partners. And I remember at the front end of it, we had one tenant who represented about 36% of our net operating income. And that's a little bit stressful to have that volume of your capital coming out of one particular deal. So we came to this market. We really liked the yield that we were getting on those assets, but wanted diversification on it. And so we've been looking for partners to come in and partner alongside with us. I have a huge personal investment in this fund. And really that's what we're looking for today, is to have others of you come along with us, because what I'm trying to do is diversify. What we started with on all of this was for me to look at long-term stable cash flow that's going to keep coming over a long period of time. That's what I want. And so I want a diversified portfolio of assets. I want a diversified portfolio of lease expiries. I want a diversified portfolio of tenants. And I want a diversified portfolio of mortgage expiries as well. So you take all of those factors, put them all together, and try to break them out into little buckets all over the place so that there's nothing particular that can cause us problems. So diving in, and the next slide is sitting here. What are we looking for? We look for investment partners. We want to acquire properties, maintain, operate them, add value. I could talk a lot about adding value and the things we try to do about that, and pay distributions. That's our business model. That's pretty straightforward. We've been pretty successful since we started this. I've been pleased with the growth and our objective of diversifying our portfolio. We started off in 2017. We had 3 additional initial properties ready to roll. We acquired a bunch of additional ones. We did a big sale leaseback with Black Diamonds that brought us to 7 properties. We did 3 additional acquisitions in 2018 that will have added about $1 million to our net annual rental income. 2019, we brought another property in, and 2020 we closed a couple of acquisitions in 2020. A really good time to be buying assets, actually, because there's capital's a little more scarce in the marketplace, and we were able to come up with some really good assets on those. So on the next slide here, so we have 13 properties in total. We sit in 10 different markets across Western Canada. And we're now $84.3 million of total assets. And so that's starting to feel like pretty good diversification that we have in our portfolio, from tenants, mortgage expiries, and on down the line. Next slide. There we are. So rent collections. This slide is actually a little bit outdated because, rent collections. Yeah. So COVID and the impact of all of that. Part of what I was looking for in this asset class was resiliency, and these assets have really shone through the whole COVID period. The vast majority of our rent has been collected. I actually think 98 is probably low, but anyway, yeah, they're wonderful assets. We've worked alongside with our tenants, but in general, they're larger institutions that are not. They're not that concerned month to month on making rent payments, so they've been great to work with. So historic performance, onto the next slide here, just a list of the various properties that are there. I see this business, a big chunk of what I'm looking for are economic bridges. I see buildings as these interesting things. If I can buy an asset that I really like in a market that I think is perhaps unloved, and we can you've got a building and I can sign a reasonable term lease on it, building perhaps that we bought below replacement cost. Anyway, you get a tenant in there for a period of time and you get a rent paid on your capital that's there while you wait for the market to turn around and better things to happen on it. So we're set up with a bunch of that. And we have seen early success in this. Our purchase price of just over $80 million is now sitting at $84 million. And when you've got some leverage on that, you can generate some good returns. So about $3.5 million of unrealized gains, and that comes off of our audited financial statements. We have fresh appraisals done on these properties every year. And yeah, and so that's given us about an 18% when you bring together the rents and the capital appreciation on these at the LP level. So next slide in. This is a recent acquisition that we did that we think is a really smart deal. This is actually tried to get this tenant several years ago, and we had another building in this particular market. It's just outside of Edmonton in Spruce Grove. And this tenant, I was trying to put them into another property that we had, and they decided they wanted a brand new fancy building. And so they went out and had a brand new fancy building built. And anyway, so now I'm pleased that we bought the building. Why I wanted that tenant is because they have a huge balance sheet, lots and lots of equity. It's over $100 million of equity sitting in the business, and their liquidity in the business is great. It's anyway, low risk, long standing tenant. We have a 10-year lease on this property, and we could buy the property at a 7.7 cap rate, which basically is the yield that we'll generate on our dollars invested. So we get to invest 12.8 million, you generate 7.7%, and we get to go to the bank and borrow a bunch of money, and so we could put a reasonable amount of leverage on this particular property, and the rates of return that it generates work out to be high teens for us. It's it's locked in for like a decade. So I'd love to do a whole bunch more, many more deals like that. Another deal that we did that we'd worked on recently is the acquisition of another building up. This is actually up in Claremont. There's 4 years remaining on the lease. The tenant that is in there. So first of all, the building is a beautiful building. The tenant has put a bunch of money into cranes and various other things. So it'd be difficult for them to get up and leave. It's a private equity backed firm with, again, a very, very strong balance sheet. So I'm not at all worried about them going away. I believe that we bought the property at a price that's well below replacement cost. And so I think there's upside that's available with that. And the cap rate of 8.96 is, I think it might be part of the opportunity coming out of COVID for us to be generating that type of yield on the assets. Yeah, so great long-term asset. It's not a sexy piece of architecture, but the financial returns on it definitely are the types of things that we're looking for. So Amy, over to you.
Perfect. So really, to summarize what we do look for as Durum Industrial REIT in bringing on investment partners is it provides an opportunity to really participate alongside an experienced and aligned management team. And we'll get into that alignment piece a little bit more. But anytime that you hear from Durum Capital and our team around alignment, we're always talking about both alignment of people and dollars. So alignment of dollars, that's where we have 12.2 million invested alongside investors. I'm not sure about those on the call, but in my world, 12.2 million is a lot of money. So that speaks to the alignment that Jay, as well as management directors and affiliates, has within the fund. The second key investment benefit is that exposure to the unique and strong performing asset class. So we think back to that video. We also think about all of our buying habits throughout COVID, and just give some thought into the number of times you've ordered something online and you see it show up on your doorstep, but we don't think a lot about that logistics and distribution and warehousing component of that transaction. And that's where we're seeing this unique and strong performing asset class really shine through, with all of the real estate trend reports speaking to the resilience of the industrial asset class. So we're looking to continue to grow that portfolio through 2021 and beyond to take advantage of that specific asset class within the real estate sector. And then the third benefit really coming down to that total target return for investors. So the potential for yield and capital growth with a total target return of 8 to 12%. So that's a little bit about the background in terms of what it is we're investing into and how we grow and operate a portfolio and add value for the investors. But what you're really looking to invest into is a Series C trust unit at $100 per investor unit. There is quarterly distributions within the fund, and that 6.5% targeted preferred return per annum paid quarterly. and then the intent to achieve a total target return of 8 to 12%. And that is inclusive of the profit split potential of 70% to investors. It is great to note that there's also a dividend reinvestment plan in place. And if you do opt in for the dividend reinvestment plan, it is at a 2% discount through your DRIP units. We are raising a total of $40 million under the existing offering memorandum, with a minimum subscription of 5,000 in investor units, and it is eligible through exempt plans. Please do be aware of the redemption restrictions at $150,000 per quarter at fair market value of the trust. And please do refer to the redemption restrictions with your private wealth advisor if you are interested in learning more. So no investment is complete without risks. So a few just to highlight within Durum Industrial REIT. Of course, as we noted, there is no guaranteed return, and the investment should be viewed as illiquid. Also need to note that there is financial performance related to COVID-19 or pandemics, infectious diseases, and virus outbreaks that are potential risks of the investment. That being said, as Jay noted, we were successful in receiving over 98% of our contracted rents through the 2020 period, and pleased to report that going into December and January here of 2021, we have received 100% of our contracted rents to date. So that collection has increased starting in 2021. One other note on the issuer risk is that limited ability to remove trustees or the general partner. And we do pull that risk out just to note that the reason behind that is that alignment of management director and affiliate dollars. So that limited ability to remove the trustees and general partner is because of that capital placed alongside the investors in the fund. But I'll pass it back to Jay to talk a little bit more about the governance structure. And while there is that limited ability, it is important to note that management can be removed by this group of individuals on the screen. So Jay, do you want to talk a little bit about governance?
Yeah, sure.
And management?
You may have troubles removing all of the trustees and directors, but they won't have troubles removing me if I'm not doing my job, and I'm well aware of that. I started my career in insolvency, and I can tell you there's a pattern that I see to businesses that get in trouble, and oversight and governance is a recurring theme that we see in companies that get into trouble. Tone at the top is incredibly important in organizations, and if you look through this list of names that are out there, you'll see a handful of ICD.D. That's the Institute of Corporate Directors. I did my ICD.D. And we have several other directors who have that. And anyway, so governance is really important to us. If you look at the caliber of people that we have here, I'm sure that you can see that they're super well qualified and also representative of serious investment in the organization. So Sean Morgan, for example, is the CFO of the Workland family office, who is a very large investor alongside this with me. We also have, there's actually an additional entity at Durum Properties, which is a very large unit holder in this, and Bob Braun sits on that. So we have, anyway, lots of oversight in all of this. And it's not just about oversight though. I believe that management teams show up much differently when they are reporting up to a board of directors that they respect. And so this is definitely a board that pulls the best out of people. Down on the management side, Judy Kwong is the managing director in charge of this file. Judy has worked alongside with me for, I was saying 12 years, but I think we're probably on to 13 or more. Anyway, it's a long-standing relationship. She's an awesome resource and MBA out of Queens. Ian Mackay has 20 plus years of experience working in the real estate space all through the system. So he's a great resource for us to have as well. I won't run through the backgrounds of all of the individuals on the board of directors, but if you give me time one of these days, I do love to talk about them all. They really are an impressive group of guys, and they do set the bar high. Yeah, so what's next? We maintain and operate our current portfolio of properties. We are looking to grow and diversify. We may even try to get something out of Alberta and Saskatchewan in the next while. We have been looking at various other markets and trying to find a spot that we like, where we can generate the types of returns that we think are exciting and see upside in the real estate beyond that, which I have to tell you is tough to find. and we pay quarterly distributions. And the distributions that we pay, I'm hoping are the tip of the iceberg, because we're not buying these assets. I'm not looking to just buy these assets for the return on them. We're trying to buy things that have a story behind them, a reason why we can get them cheap, and a reason why things are going to change. As I mentioned earlier, I see these assets as being bridges from one market structure to another, and hopefully we can buy assets in markets that are not exciting and ultimately sell them or release them up again in a much more exciting market. That's what we're looking for. Yeah, so business is good. I don't know, Amy, if you've got anything else to add on to all of that, but we've had a lot of fun with this portfolio, and I'm hoping that we can do a whole bunch more of the same over the next several years. Maybe we have some questions.
Jay, Amy, thank you very much for your presentation. I do have some questions here. For those of you that are attending the call, please, again, just click on the Q&A box at the bottom and jot in any thoughts, comments, or questions that you have, and I will read those out. Jay, you just referenced you're not just buying assets for income, you're buying assets because you see potential to get them from one market structure to another. What do you mean by a market structure, and like how do you see these assets being repositioned?
Yeah, so Warren Buffett's my favorite investor, and he always talks about pendulums swinging through time, and capital markets investors apply capital to where return is. It's kind of a little bit of a rearview mirror methodology to investing, but a whole bunch of capital gets applied, and the yield and the return on those assets eventually goes away because you've got too much capital chasing too few opportunities. So I'm always looking for the spots where the pendulum's been swinging in the other direction, and everyone's like, yeah, nothing's going on over there. Don't know who wants to be there. That's a terrible market to be in. And well, I don't know, is it a terrible market? And so you look at those, and generally the difference between those two is time. I've had the pleasure of working with a bunch of sizable family offices, like the Workman Family Office, the Braun Family Foundation, and they have a very different view of investing than certainly than the public market guys. Their horizon is much longer, and they're looking for these types of cycles that are going on. And generally, when you go in at the bottom of the market, and everyone's like, "Oh, that's a tough spot to be in, and who wants to be there?" You can buy assets at a much better, just good old fashioned cash flowing yield, like buying some of these things at an 8.9 with a company that's got a serious balance sheet in it. I mean, at a replacement cost or at a price that's well below replacement cost. Those are good deals. And so you have time between now and really what's just going to happen, I think, in a lot of cases, is that market will change. And all of them all have a different philosophy on, but that is a pattern that we're looking for.
Great, thank you. That really helps clarify your comment. I have had the pleasure of spending quite a lot of time with the Durum team over the last, it's been years now, probably 7 or 8 years. Jay, or Amy, could you maybe talk a little bit about what your office looks like in terms of, it's not just the two of you going out and looking for properties and deciding if you want them. You've got some serious capacity within your organization. And I'd love to hear just a brief description of what the lay of your office looks like.
Is that Amy or is that me?
Let's start with Amy.
For sure. And I think, so I've been with the Durum team now for 5 years. So I've watched the team grow from, I think I was the 5th employee hired, to now we have over 30 full-time employees, or close to 30 full-time employees within our Durum offices. And what I've come to learn is that we really are a bit of a family office structure. So it's looking at how we're investing our investor dollars and then bringing in additional investors into those specific funds. And so it's looking after kind of a portfolio of investments, and certain people looking after specific investments, and Durum Capital managing across those investments. So when we look at the number of people and the caliber of people we have within the organization, it really is coming down to the right alignment of people for the job at hand. So we have a dedicated team to industrial real estate. We have a dedicated team to development land. We have a dedicated team to the energy sector. And there's a few that kind of overlap, and Jay's really leading the ship as far as how do we match operations with the services we provide to these other entities. So that's my view of the office infrastructure.
It sounds like the piece that I'd add to it is, over the long term, my vision is that we have this super high quality brain trust. I'm always looking for incredibly smart people that can come in and help us make decisions. I see assets as being relatively fluid over time, and maybe certain assets we want to get out of and we want to get more of another class. Anyway, I think I've been blessed on attracting and having some incredible people come and join our team. And I think if you look at the backgrounds and learn a little bit more about just about anyone in here, we tend to have people who have high levels of education and they have fire in the belly and awesome resources. Over the last year, we brought in Bill Robinson. He's been a director of mine for over 20 years now, but he's the former CEO of the Mannix family office. He ran Manvest, which is Fred Mannix's private equity arm, for 20 some years. Just a ton of experience on, I don't know how many, I'll have to ask him one of these days how many boards it's been, but Sleep Country Canada, A&W Canada, several of the entities that I've had over the years. So yeah, anyway, it's a really fun organization. I have to love it because I've put it together. So
that's great.
with a lot of help of others too.
So Jay, how, with this investment with the industrial REIT specifically, how do you get paid?
How do I get paid? First of all, I always like to say that our investment is always meaningfully more important than any fees that we generate on the thing. And so we have the quantum of dollars that we have in this is very large vis-a-vis any fees that we generate. But we get a percentage of funds under administration, so 2%, and then there's a carried interest that we would get over a threshold. And actually, I would turn that back to Amy to tell you what the calculation is on that and how it works, because in all honesty, I haven't really spent that much time looking at it. Amy?
Yeah, so that would be when we talk about the 70% profit split, that additional 30% would be essentially like a performance fee to the manager through the general partnership.
Okay, great. Thank you. So the next question is, Jay, can you describe what the exit strategy looks like? The investment has got a timeline associated with it. Are you planning on actually selling these assets back into the open market?
So I guess there's a handful of different ways that an exit can happen for an investor. There is the ability to redeem. There is some thought around taking the whole thing, and you could sell it into the market as a consolidation play for someone. I was looking at Dream and Granite, and there's another one of the large REITs that I was looking at recently. They're trading one of them is trading sub 4% yield. I mean, those are, so we look like a tasty little morsel to someone like that. Anyway, so that could be a path, or maybe we carry on and rotate buildings through and continue to build, and unit holders want to get out, they can redeem out.
Sure. For anybody on the call who isn't familiar with how cap rate calculations work, can you just explain what you mean by a sub 4 and a tasty morsel?
Oh, okay. So the yield. So when somebody invests in our fund, we're looking to provide capital appreciation plus a yield in the assets, and investors are getting at 6.5% on an investment in us. If you owned, and I'm sorry, I should have notes on this in front of me. I forget if it's Granite or Dream, but one of those was trading below a 4% yield. The other was just above it. So you get 6.5 with us, or you can go to the public markets and to get something that is priced to perfection. And so when we have a yield of our size, to acquire us as a small firm, those are metrics that work.
Great. So to summarize, this portfolio could look very attractive to a larger public player in the marketplace that has raised capital and has promised investors in and around the 4% yield mark.
Yeah, but I mean, and beyond.
Absolutely, absolutely.
Yeah.
Absolutely.
Yeah, we're growing by buying a building at a time. The larger public guys will grow by buying other REITs and picking up a batch of properties at a time.
Certainly, certainly.
Yeah. And that's not
What
to
is
say
your-
that I like the opportunity of trying to grow to that point too, but we're here to make money. So if the right opportunity comes along, I'm all ears.
For sure.
As we think of this as an investor first and foremost.
Absolutely. So what does your acquisition pipeline look like in the next 6 to 12 months?
Well, Amy, you might have things to add to this, but I would say there's a lot of things that are coming at us that we're quite excited about. And yeah, we need some capital to go and do these things. So we could be quite active.
There's a lot more buildings currently under review than we would have the ability to currently purchase. So we are actively looking at those acquisitions and really getting smart on some of the submarkets in Eastern Canada as well. So we know that geographic diversification is an element that a lot of people are interested in, something that we're also interested in from an operations standpoint. That being said, we have had great success with our acquisitions in Western Canada, primarily in Alberta. I know Jay is pretty optimistic around Alberta acquisitions and would love to do more of them, but we are looking quite heavily at Eastern Canada for our next acquisition and currently reviewing a sizable acquisition in a sub-market in Ontario. So.
Super. I'm going to change the direction of this conversation for just a few minutes, because I recall a couple of years ago coming into your office in Calgary and having an eye-opening conversation about Jay's management style. Jay is obviously the head person in the organization, but my observation, having been a business partner and an investor of yours for a number of years, is that Jay has hired a lot of individuals who are women. Jay has hired a lot of individuals who have decision-making authority and ability within the organization. And my perception is that Jay is not a top-down manager where he's saying, this is what I want to do and this is how we're going to do it, and Amy and Chaim go fetch, at all. And so Jay, can you maybe talk a little bit about what your management philosophy is and how your organization uses the coaching to stay on track?
Boy, there's lots to talk about there.
Sure.
So let me start off with, we don't target women. We target the most qualified people we can find for the role. And it just turns out that a large percentage of them are women. And so, yeah, although I did grow up with 4 older sisters, so I'm quite comfortable having a lot of women around. Anyway, so yeah, that's what we're doing. We're hiring the best man for the job, so to speak, and half of them ended up not being men. So, and then our style, I don't think we are. I would say if there's a complaint in the organization, it's that I don't give enough instruction or enough direction. There's a lot of people who want more structure and on down the line. And I think Amy can attest to sometimes feeling like there's a lot of weight on her shoulders, perhaps. Sometimes people feel overwhelmed with the amount of responsibility that's given to them. I'd like to try to dial it back to keep them feeling excited by the amount they have and not push it too far. We started quite a few years ago a process called Traction. Traction is a business building process. A good friend of mine built her company up into actually a sizable empire now, operating under the systems. And so we have an annual plan, we have quarterly plans. There's a real rhythm and cadence on how things happen in the organization and a system of public accountability. So it's pretty clear on who's supposed to have how much of what stuff done by when, and what done looks like is pretty clear in the organization. Amy, maybe you're better to comment or add to that. I'll stop talking.
I would actually sum up in one line, in some respects, that it's management philosophy or leadership style within the organization. You could summarize as structure in a world of possibilities. So Jay is really that leader. I would not refer to Jay necessarily as the manager within this organization, but he's that visionary leader. So he's the one who goes out and sees this world of possibilities. He's the one who asks the question of what if. And he's been very successful in surrounding himself with people who put that structure to that possibility. And so we're the team that executes. We pick up the sound bites that Jay has come across, or this philosophy from a leadership perspective, where he's surrounded by the team of people who will execute on that. And when we look at tying that back to the funds in place, particularly Durum Industrial REIT, it did start with that field of possibilities, that what if we go out to the market and look at doing this on a bigger scale? Like, we have these properties ourselves, but what if we look to grow this? What could that look like for us, for our investors, for our stakeholders? So we went to the market. We partnered with Raintree. We looked at raising capital, and we're executing on that what if to now have a portfolio of 13 properties and growing. So now it's, what's the next challenge? What if we look at other businesses, other opportunities to continue to grow this portfolio? And I'll leave it at that to say, stay tuned to the next execution on that what if. We've reached 0% vacancy in our portfolio, and there will be some exciting announcements around that, because Jay's had the audacity to ask the question of what if, and surrounded by people who have the ability to execute.
Amy makes that sound great. Like, I come up with these ideas and people are like, okay, let's go do it. Isn't that wonderful? And that's not true. We have a core value of ours is courage and candor, and Amy lives it better than anyone. And the vast majority of my ideas actually get beaten up on the shop floor. But it's a great team. All of these things that come forward. I'm not the only one who comes up with ideas either. There's a ton of great ideas that come out of the team, and there's a good filter on what it is that we should be moving forward with. And so we're where original thought meets decisive, considerate action. We execute on things, and it's actually a small percentage of the audacious ideas that actually get everyone's attention to execute on. So.
Well, I certainly appreciate being an investor and being a business partner of yours. I've learned so much from you over the years. Thank you very much for today. I always respect and appreciate your time. We have no further questions. For those of you who are attending this call or listening to a recorded version, if you have any questions about Durum Industrial REIT or Raintree, please reach out to your Raintree advisor. If you don't have one, send a note to Raintree Financial Solutions by email or phone, and we will get in touch with you shortly. Thank you, everybody. Have a fantastic rest of the day. Bye for now.
Thanks.